As the stock market is currently closed, the closing price for BigBear.ai Holdings Inc. under the ticker symbol BBAI as of the final session on Friday, June 19, 2026, sits at exactly $3.92 per share, showing a modest intraday upward movement of 1.03% with a daily volume of over 34 million shares shifting hands. While retail traders on popular platforms are watching this near $4 mark as a simple speculative play, a deeper look reveals something far more interesting beneath the surface. The broader market narrative paints this company as an unstable microcap tech firm struggling to stay afloat in a massive wave of infrastructure development. But while the average retail investor views it through that lens, major asset management firms like BlackRock and Vanguard are quietly maintaining significant multi-million share stakes. This institutional accumulation creates an immediate tension between public perception and actual block order reality, signaling that sophisticated capital sees structural value in its specialized federal contracts that casual market observers completely overlook. The general consensus among individuals engaging in self-investing is that minor software firms are too risky when compared to large-cap giants. When retail market participants open their brokerage accounts to review their long-term holdings, the prevailing belief is that only massive companies can survive high interest rates. This perspective leads many to allocate funds exclusively toward megacaps, ignoring smaller data intelligence operators. However, the contrarian view suggests that small-cap federal suppliers hold a completely different structural position in the economy. Unlike consumer-facing tech brands that rely heavily on discretionary spending, a specialized analytics provider serving the Department of Defense operates within an isolated ecosystem protected by multi-year government appropriations. This structural separation protects their backlog from immediate economic downturns, meaning the public focus on near-term cash burn often misses the massive revenue protection provided by national security budgets. Looking at recent market activity, the stock has experienced heavy trading volume and high volatility, oscillating significantly within its 52-week range of $3.01 to $9.39. This intense price action is frequently driven by automated retail algorithms and sentiment shifts on various social media platforms. When macroscopic liquidations sweep through speculative tech sectors, small software firms are often the first to feel the downward pressure regardless of their underlying financial health. Institutional activity shows a steady accumulation patterns by major index providers, which helps stabilize the floor around the $3 mark during broader index pullbacks. Recent earnings reports have provoked sharp reactions, with short-term traders rushing to exit positions whenever quarterly revenues show flat growth, while long-term institutional buyers use these localized panics to absorb shares at a discount. This tension reflects a clear divergence between short-term macro trading strategies and patient capital accumulation. The broader macroeconomic environment continues to put significant pressure on small-cap tech equities. With interest rates remaining elevated compared to the previous decade, early-stage technology companies face much higher hurdles when seeking capital to refinance their existing obligations. This macroeconomic reality forces firms to focus strictly on achieving positive cash flow rather than pursuing growth at all costs. For an individual managing their individual brokerage account, distinguishing between companies that require constant capital dilution and those with a sustainable path to self-funding is critical. The market has been unforgiving to enterprises with weak balance sheets, frequently punishing any small software provider that misses its quarterly estimates. Yet sector momentum can shift rapidly when federal agencies ramp up their defense allocations, creating sudden pockets of outperformance for well-positioned analytics suppliers. Looking at recent market activity, the stock has experienced heavy trading volume and high volatility, oscillating significantly within its 52-week range of $3.01 to $9.39. This intense price action is frequently driven by automated retail algorithms and sentiment shifts on various social media platforms. When macroscopic liquidations sweep through speculative tech sectors, small software firms are often the first to feel the downward pressure regardless of their underlying financial health. Institutional activity shows a steady accumulation patterns by major index providers, which helps stabilize the floor around the $3 mark during broader index pullbacks. Recent earnings reports have provoked sharp reactions, with short-term traders rushing to exit positions whenever quarterly revenues show flat growth, while long-term institutional buyers use these localized panics to absorb shares at a discount. This tension reflects a clear divergence between short-term macro trading strategies and patient capital accumulation. The broader macroeconomic environment continues to put significant pressure on small-cap tech equities. With interest rates remaining elevated compared to the previous decade, early-stage technology companies face much higher hurdles when seeking capital to refinance their existing obligations. This macroeconomic reality forces firms to focus strictly on achieving positive cash flow rather than pursuing growth at all costs. For an individual managing their individual brokerage account, distinguishing between companies that require constant capital dilution and those with a sustainable path to self-funding is critical. The market has been unforgiving to enterprises with weak balance sheets, frequently punishing any small software provider that misses its quarterly estimates. Yet sector momentum can shift rapidly when federal agencies ramp up their defense allocations, creating sudden pockets of outperformance for well-positioned analytics suppliers. Understanding how to navigate these microcap fluctuations requires looking closely at how modern tools manage such assets.
Many modern automated systems, such as Schwab Intelligent Portfolios, utilize mechanical asset allocation models that tend to filter out microcap equities due to their inherent volatility metrics. When an individual seeks automated investment help, these algorithmic systems typically favor stable index instruments or large caps like Tesla stock, Apple stock, or Nvidia stock to construct a balanced, risk-adjusted portfolio. Consequently, smaller enterprises rarely receive passive inflows from institutional robo-advisory platforms, leaving their price discovery almost entirely dependent on active traders and specialized hedge funds. This lack of automated institutional indexing support means that small-cap software assets often trade at severe discounts relative to their long-term federal contract pipelines, offering distinct anomalies for active stock market participants. For everyday market participants using a modern online individual brokerage, the landscape of picking individual stocks has shifted dramatically. Platforms that provide comprehensive online investment tools have made it incredibly easy to execute complex trades at the click of a button. Whether an investor utilizes the classic Fidelity trading platform to manage long-term wealth or prefers the sleek design of the Robinhood app for active tactical plays, the accessibility of market data is unprecedented. This democratization of online investing means that a small software firm can experience sudden surges in retail volume overnight based on a single defense contract announcement. However, without a deep understanding of federal procurement cycles, retail accumulation can quickly turn into a massive rout when the next quarterly report shows that contract revenues will take several quarters to fully manifest on the official income statement. To analyze this accurately, we must examine the specific systems investors use to interact with the market. Active participants managing their personal accounts through Interactive Brokers stock trading systems often analyze depth of market data and institutional order flows to spot where block orders are being placed. These advanced participants look closely at Interactive Brokers trading volume nodes to identify institutional support levels, recognizing that a small firm stabilizing near its annual lows can represent a unique structural trade. Meanwhile, less technical retail participants might rely on the simplicity of a Robinhood stock trading account, focusing primarily on basic price charts and recent news headlines. This bifurcation in trading tools often exaggerates the price swings of microcap equities, as different tiers of investors react to the exact same corporate development with entirely different execution speeds and time horizons. Let us look deeper into the underlying business architecture that supports this enterprise. Established as a data analytics and artificial intelligence provider, the company focuses on delivering advanced decision support systems for complex federal and commercial environments. Their core business model involves processing massive disparate data sets to generate predictive insights for defense logistics, national security operations, and supply chain management. Looking back at older historical reports, the company arrived on the public markets through a business combination with a special purpose acquisition company, a structural path that initially provided substantial cash, but also brought intense regulatory scrutiny and immediate public market volatility. Over past fiscal cycles, their performance has been characterized by lumpy revenue recognition, which is a structural feature of working with massive government bureaucracies, where contract awards can be delayed for months by administrative protests or budget reviews. The acquisition of Pangiam was a notable corporate milestone, aimed at expanding their footprint in image recognition and biometric facial analysis for national security environments. This integration represents a major component of their long-term structural strategy, allowing them to cross-sell advanced software solutions across a much broader pool of federal agencies. While early financial statements following the merger showed increased operational expenses that weighed heavily on net margins, the long-term goal is to consolidate redundant corporate infrastructures and achieve positive adjusted earnings before interest, taxes, depreciation, and amortization. Investors tracking these developments through a specialized SoFi trading platform or via comprehensive Fidelity Investments accounts must balance these high integration expenses against the expanded total addressable market that the combined entity now commands in the federal security space. When executing self-directed research on popular consumer investing sites, it is easy to get lost in the noise of short-term price movements and lose sight of the long-term structural framework. Active participants on the SoFi Invest app often debate whether small-cap technical suppliers can withstand competition from massive defense legacy systems. This is where the tension between expectation and reality becomes most apparent. The market expects a small software firm to scale at the same rapid pace as a consumer software application, but the reality is that federal procurement is slow, methodical, and heavily reliant on deep-rooted institutional trust. A company that secures a spot as a trusted program integrator for the United States Army or Air Force gains a structural moat that cannot be easily displaced by a competitor simply offering a shinier user interface or a cheaper alternative. Please take a moment right now to comment below how many shares of BigBear.ai you currently hold in your portfolio, or if you are simply tracking it on your watch lists. As we look toward the upcoming corporate catalysts, the next major event on the horizon is the estimated quarterly earnings announcement scheduled this 10th, 2026. This upcoming financial report will be a critical test for the company, as market analysts will be looking closely for signs of organic revenue acceleration and margin stabilization following their recent structural integrations. If the company reports an unexpected reduction in net losses or showcases a significant expansion in its federal contract backlog, it could trigger a rapid short-covering rally across active trading ecosystems. Conversely, if corporate revenues remain stagnant while operational cash burn increases, the stock could easily retest its previous 52-week lows, forcing retail participants using Robinhood Investments or SoFi investing systems to reassess their short-term risk parameters. In a broader context, the future outlook for this asset depends heavily on two distinct operational scenarios. In the bull case, the company successfully leverages its deep federal relationships to secure high-margin commercial contracts in aviation logistics and maritime supply chain tracking, transforming itself from a pure government contractor into a balanced dual-use software provider. This transition would significantly improve their cash flow profile and allow them to achieve sustained profitability without needing to dilute shareholders through secondary equity offerings. In the bear case, prolonged federal budget debates and administrative gridlock delay new contract awards, leaving the firm dependent on its existing backlog, while high interest rates make debt capital prohibitively expensive. This would squeeze their current cash reserves of roughly $106 million, potentially forcing a defensive corporate restructuring. For an investor managing their long-term wealth through diversified vehicles like Fidelity mutual funds, specialty Fidelity ETFs, or automated portfolios managed by a SoFi robo-advisor, small-cap software equities represent a high-beta tactical sleeve rather than a core foundation. Many active traders utilize specialized features like Robinhood fractional shares to build small positions over time without exposing their entire capital base to sudden downside gaps. Others prefer to manage their exposure through advanced interactive brokers platform tools, using strict stop-loss orders and protective options to hedge against sudden capital destruction during macro market liquidations. Regardless of the specific execution tool used, managing an asset with a high historical volatility profile requires an unwavering focus on objective structural metrics rather than emotional sentiment. When building a comprehensive approach to self-directed capital management, individuals often compare different online systems to find the lowest cost framework for their trading style. Some analyze interactive brokers' fees to ensure that high-frequency tactical adjustments do not erode their total net returns over time. Others maximize the utility of specialized retirement accounts, utilizing Fidelity IRAs or taking advantage of the convenience offered by a Fidelity mobile app to monitor their long-term capital allocations while on the go. The ultimate goal across all these approaches is to optimize the